Before we begin, it's crucial to understand that the information presented in this video is for educational purposes only. I am not a licensed financial advisor or insurance agent. Car insurance is a complex product that is heavily regulated and varies significantly from state to state. For personalized advice that fits your specific circumstances, you should always consult with a qualified and licensed professional. You just opened your auto insurance bill, and your jaw hit the floor. It went up. Again. You haven't had an accident. You haven't gotten a single speeding ticket. You're driving the exact same car on the exact same commute you've had for years. So why are you paying more? It feels arbitrary, like the insurance company just spins a wheel and sends you a bill for whatever number it lands on. It's a black box and you're just supposed to pay what it tells you to pay. Well, today we are going to smash that black box wide open. We're going to demystify the entire process. By the time you finish this series, you will understand exactly what factors are secretly driving up your insurance costs, and more importantly, which of those factors you actually have the power to change. You're going to go from a confused customer to an educated consumer, armed with the knowledge to potentially save hundreds or even thousands of dollars a year. Let's start with one of the biggest factors, and it's one you probably think about the least: where you park your car at night. I'm talking about your zip code. That's right, your address can have a more dramatic impact on your insurance premium than a speeding ticket. Let me tell you about two hypothetical drivers. Let's call them Sarah and Mike. They are the same age, have identical driving records, and they both drive a 2022 Honda CR-V. The only difference? Sarah lives in a quiet, rural zip code in Boise, Idaho. Mike lives in a dense, bustling zip code in Brooklyn, New York. Mike could easily be paying 3 to 4 times more for his insurance than Sarah. Same driver, same car, radically different price. Why? Because when you buy insurance, you're not just insuring yourself. You're insuring yourself against the risks of your environment. Insurance companies are masters of data, and they have decades of claims information broken down by geographic location, right down to the specific zip code. They aren't insuring you in a vacuum. They're insuring you in your neighborhood. So what are they looking at? First, traffic density and accident frequency. A zip code in the heart of Los Angeles has exponentially more cars on the road per square mile than a suburb in Nebraska. More cars mean more chances for fender benders, sideswipes, and major collisions. Your personal driving skill is irrelevant here. It's about the statistical probability of someone else hitting you. Second, they look at crime rates, specifically vehicle-related crime. Is your zip code a hotspot for car thefts, vandalism, break-ins? The company has to price in the risk that they'll have to pay out a claim because your car was stolen from your driveway or your window was smashed overnight. Third is weather. A zip code in Oklahoma's Tornado Alley or along the Florida coast during hurricane season presents a much higher risk of comprehensive claims for hail damage, flooding, or wind damage than a zip code in sunny, mild San Diego. These acts of God are a huge cost for insurers, and that cost is passed on to the policyholders in that area. And finally, there's a surprising one: litigation. In some geographic areas, people are simply more likely to hire a lawyer and sue after an accident, even a minor one. These legal battles and larger settlement payouts dramatically increase the cost of claims for the insurance company in that zip code. So if you live in a sue-happy area, your rates will reflect that increased legal risk. It feels unfair, doesn't it? You're being charged more because of the driving habits of your neighbors, or the local crime rate, or the weather patterns you can't control. But from the insurance company's perspective, it's all about predicting risk. And geography is one of their most powerful predictors. Now let's move from where you drive to what you drive. The specific car you choose is a massive piece of the puzzle, but it's far more nuanced than just sports cars are expensive to insure. Of course, the manufacturer's suggested retail price, or MSRP, is the starting point. A brand new $90,000 Mercedes is going to cost more to replace than a $15,000 Kia Rio. That's obvious. But the real story is in the details. Let's talk about repair costs. This is huge. Two cars can have the same sticker price, but one can be dramatically more expensive to insure because of how much it costs to fix. Think about a high-end Audi with specialized aluminum body panels and a dozen sensors embedded in its front bumper. A minor fender bender that might cost $800 to fix on a Ford Focus could easily turn into an $8,000 repair bill for the Audi. Insurance companies know this. They have data on the cost of every single part and the typical labor hours for common repairs for every model. A car with expensive, hard-to-source parts will always carry a higher premium. Next up, safety ratings. But here's the twist. It's not just about how well the car protects you in a crash. That's called passive safety, things like airbags and a strong frame. That's important, of course. But what insurers are getting really excited about now is active safety. These are the features that help you avoid an accident in the first place. Think automatic emergency braking, lane keep assist, blind spot monitoring. Cars equipped with these technologies are statistically proven to be in fewer accidents. Fewer accidents mean fewer claims for the insurance company to pay. So a car loaded with modern safety tech can often earn you a significant discount, sometimes offsetting the higher purchase price. The insurance company isn't rewarding you for being safe. They're rewarding you for driving a car that actively reduces their financial risk. Then there's the theft risk. Every year, the Highway Loss Data Institute releases a list of the most stolen vehicles in America. If your car is on that list, you can bet your insurance rates are going to reflect it. For years, it was cars like the Honda Accord and Honda Civic. More recently, certain models of Kias and Hyundais became massive targets due to a vulnerability that made them easy to steal. If you own one of those high-risk vehicles, the comprehensive portion of your insurance, the part that covers theft, is going to be much, much higher. It has nothing to do with you and everything to do with the car itself being a magnet for criminals. And yes, we have to talk about performance. It's not just about the red paint and the racing stripes. Insurers look at cold, hard numbers. They look at the horsepower-to-weight ratio. A lightweight car with a powerful V8 engine is, statistically speaking, more likely to be involved in a high-speed accident than a heavy minivan with a V6. The data shows that drivers of high-performance vehicles tend to drive more aggressively and file more expensive claims. It's not a judgment on your personal driving style. It's a bet based on the historical behavior of thousands of other people who bought the same car. So already we can see it's not simple. The cost of your insurance is being pulled in dozens of different directions by your zip code and your vehicle choice before we even begin to consider who you are as a driver. We've peeled back the first two layers of this complex onion, but we're just getting started. The factors that we're going to discuss next are even more personal, and for many people even more controversial. Because one of the biggest factors that determines your rate has nothing to do with your car or your address. It's a 3-digit number that you probably associate with getting a mortgage or a credit card, but insurers are using it to predict something else entirely: how likely you are to cost them money. That 3-digit number is your credit score, or more accurately, a version of it called a credit-based insurance score. And right now you're probably thinking, what on earth does my Visa bill have to do with my ability to merge onto a highway? Feels completely random, feels unfair. And in some states it's actually illegal. But for the vast majority of Americans, this secret score is one of the single biggest factors in determining how much you pay for car insurance. In some cases, it matters even more than your driving record. So what's the logic? How did we get here? Insurance companies will tell you it's not about judging your character or your wealth. It's about one thing: data. Decades ago, actuaries, the mathematicians of the insurance world, started crunching numbers on a colossal scale. They were looking for patterns, for any characteristic that correlated with a higher likelihood of filing a claim. They looked at everything, and they stumbled upon a connection that was so strong, so statistically undeniable, that they couldn't ignore it. People with lower credit scores as a group file more claims, more frequent claims, and more expensive claims. The correlation is so powerful that a 2007 study by the Federal Trade Commission confirmed it. They found that credit-based insurance scores are effective predictors of risk. According to the data, your financial habits are a surprisingly accurate crystal ball for your future on the road. The insurance industry's theory goes like this: a person who is responsible with their finances, who pays their bills on time, doesn't take on too much debt, and manages their money carefully, is also more likely to be a responsible person in other areas of their life. They're more likely to get their oil changed on time, replace their bald tires, and drive cautiously to protect their asset, their car. They see financial responsibility as a proxy for overall personal responsibility. It's not about how much money you have. It's about how you manage what you do have. A person with a 750 credit score isn't necessarily a better driver than someone with a 550. But when you zoom out and look at millions of drivers, a clear pattern emerges. The group of drivers with 750 scores will, statistically, cost the insurance company less money over time than the group with 550 scores. And insurance is, at its core, a game of statistics. They aren't betting on you as an individual. They are betting on the group of people who look just like you on paper. Now, it's important to know that the score they use isn't the exact same FICO or Vantage score you see when you apply for a credit card. It's a specialized version. They pull your credit report from the major bureaus, Equifax, Experian, TransUnion, but they weigh the information differently. They're looking specifically for patterns of stability and reliability. Things like a long history of on-time payments are golden. Having different types of credit like a mortgage and a credit card, and managing them well is a plus. On the other hand, things like recently opening a lot of new accounts, having high credit card balances, or having accounts in collections are major red flags for them. What they are legally not allowed to consider from your credit report are things like your race, religion, gender, marital status, or nationality. They also don't factor in your income. This is a crucial point. You could be a millionaire with a terrible credit score because you're forgetful with bills, and you would pay a higher insurance rate than a student with a modest income who has a pristine, albeit short, credit history. But this is where the whole system becomes incredibly controversial. Because life is messy. A major medical emergency can destroy even the best credit. A sudden job loss, a divorce, a family crisis. These events can send your score plummeting, through no fault of your own. Does a cancer diagnosis suddenly make you a reckless driver? Of course not. But the algorithm doesn't know the story behind the numbers. It just sees a lower score and flags you as a higher risk. Critics call this a poverty penalty. They argue that using credit scores disproportionately punishes low-income individuals and minorities, who statistically have lower credit scores on average. It creates a vicious cycle. If you're struggling financially, your credit score might drop. Because of that, your essential expenses like car insurance go up. This makes it even harder to get back on your feet, and your credit score suffers even more. You're being charged more for insurance not because you're a bad driver, but because you've had bad luck. The debate has gotten so heated that several states have taken action. California, Hawaii, and Massachusetts have banned the use of credit information in setting auto insurance rates altogether. More recently, Washington and Michigan have passed laws that significantly restrict its use. In these states, your financial history can't be used against you when you buy car insurance. But in the other 45 states, it's fair game, and its impact is staggering. Let's put this into real numbers. Imagine two identical twin sisters, both 30 years old. They live in the same apartment, drive the exact same 2022 Honda Civic, and have spotless driving records. No accidents, no tickets. The only difference between them is their credit score. Twin A has excellent credit, an 800. Twin B has poor credit, a 550, maybe because of some student loan issues and a medical bill that went to collections. Twin A with excellent credit might get a quote for her insurance at around $1,500 a year. But Twin B? Her quote for the exact same coverage on the exact same car could be $3,000, or even $4,000 a year. Double the price or more. For nothing she did behind the wheel. She is being charged thousands of extra dollars based on a financial number that has no direct connection to her driving ability. This is happening to millions of Americans every single day. So what can you do about it? This might be the most powerful, yet least known way to lower your car insurance costs. You have to treat your credit score like it's a critical part of your car's maintenance. First, get your credit report. You are entitled to a free one every year from each of the 3 major bureaus. Go through it line by line. Errors are surprisingly common, and a single mistake could be costing you a fortune. Dispute any inaccuracies immediately. Second, the basics of credit health are paramount. Pay every single bill on time every time. Payment history is the single biggest factor in your score. Even a single late payment can have a significant, lasting impact. Third, keep your credit card balances low. A good rule of thumb is to use less than 30% of your available credit limit. This shows insurers you're not overextended. Finally, don't apply for new credit too often. Each application can cause a small temporary dip in your score. Improving your credit is not an overnight fix. It's a marathon, not a sprint, but the payoff is enormous. Moving from a poor credit tier to a good one can save you more money on your insurance than almost any other single action you can take. It gives you back control from a system that often feels like it's working against you. So we've uncovered the secret number that can double your insurance bill. A factor that has nothing to do with how you drive. But what about the most obvious factor of all? Your actual driving record. You might think a clean record means you get the best price, but the way insurers look at your history is far more complex, and sometimes far less forgiving than you'd ever imagine. A single ticket from years ago could be costing you a fortune right now, and you wouldn't even know it. The truth about how they scrutinize your past is our next stop. Think of your driving record not as a piece of paper filed away in a dusty government office, but as a living, breathing digital profile, a financial ghost that follows your every move on the road. Insurance companies don't just glance at this profile. They perform a full forensic analysis on it. They are the detectives, and your driving history is the crime scene. They are looking for patterns, for clues, for anything that helps them answer one single billion-dollar question. How likely are you to cost them money in the future? And the answer they come up with is written directly on your insurance bill. Let's start with the most obvious piece of evidence: traffic violations. Tickets. We all think we understand them. You get caught speeding, you pay a fine, maybe you go to traffic school, and it's over. But in the eyes of an insurer, it's just the beginning. They categorize these violations with the precision of a biologist classifying species. First, you have your minor infractions. This is the everyday stuff: rolling through a stop sign, a busted taillight, or going 10 to 15 miles per hour over the speed limit. A single one of these might not move the needle much. Your insurer might even give you a pass, especially if you have an otherwise clean record. But get 2 or 3 within a short period, say 3 years, a pattern emerges. Suddenly, you're not just a person who made a mistake. You are a person who consistently demonstrates risky behavior. You are statistically more likely to be in an accident, and your premiums will begin to climb. Then there are the major violations. This is the stuff that makes insurance underwriters sit up straight in their chairs. We're talking about DUIs or DWIs, reckless driving, street racing, or leaving the scene of an accident. A single one of these on your record is a catastrophic event for your insurance rates. It's a giant, flashing neon sign that screams, high risk. It's not uncommon for your premium to double, triple, or even more after a DUI conviction. In fact, many standard insurance companies will drop you altogether. They'll non-renew your policy at the first opportunity, forcing you into what's called the high-risk or non-standard market. This is a whole different world of insurance with sky-high prices and bare-bones coverage, a financial penalty box you'll be stuck in for years. The crucial thing to understand is that it's not just that you got a ticket, it's what the ticket was for. A ticket for going 25 miles per hour over the limit is viewed exponentially more severely than one for going 10 over. Why? Because extreme speed is a direct correlate to more severe, more expensive accidents. The insurer's algorithm sees that and calculates the potential for a multi-million-dollar payout. They are not judging your character. They are calculating their financial exposure. Now let's talk about the second and arguably more significant piece of your driving history: at-fault accidents. A speeding ticket tells an insurer you might get into an accident. An at-fault claim on your record is proof that you did. This is where the real financial pain begins. The key phrase here is at fault. If someone runs a red light and T-bones you, your insurance company will likely see you as the victim, and your rates may not be affected. But if you were the one who rear-ended someone because you were checking a text message, you are deemed at fault, and the consequences will be swift. When you file a claim, a complex investigation begins. Adjusters review police reports, interview witnesses, and analyze vehicle damage to determine who was responsible. Even if you're only found to be partially at fault, say 50%, you can still expect a rate hike. The size of that rate hike depends on 2 things: the severity of the accident and your prior record. A minor fender bender with a $2,000 repair bill will cause a noticeable bump in your premium. But an accident where you total another car, and the other driver needs extensive medical care? That's the kind of claim that can haunt your record for 5 to 7 years. The total payout for that claim, property damage, medical bills, legal fees, gets attached to your profile. You are now the person who caused a $100,000 loss. To the insurer, you are no longer a theoretical risk. You are a proven liability. Many companies offer something called accident forgiveness, but this is often a one-time only pass, usually reserved for long-time customers with a previously spotless record. It's a marketing tool, a golden ticket, but once you use it, it's gone. A second at-fault accident, and you will face the full financial force of their risk algorithm. So how do insurers keep track of all this? They use a system that is, for most people, a complete black box, the point system. Now, there are actually 2 different point systems running in parallel. First, there's the one your state's DMV uses. Accumulate too many points from tickets and accidents, and the state can suspend or revoke your driver's license. This is the government's way of getting dangerous drivers off the road. But your insurance company has its own, separate, proprietary point system. This system is their secret sauce. It's an internal scorecard that translates your driving behavior directly into dollars and cents. A minor speeding ticket might be 1 or 2 points. An at-fault accident could be 4 or 5 points. A DUI could be 10 points or more. Each company's system is different, which is why a quote from one insurer can be wildly different from another for the exact same driver. One company might heavily penalize speeding, while another is more concerned with accidents. The more points you have on this internal record, the higher the risk tier you are placed in. And each tier comes with a different base rate for your insurance. This is why your renewal premium can suddenly jump by 30%. It's not an arbitrary price gouge. It's because a ticket you got 6 months ago finally processed, added points to your profile, and kicked you into a more expensive risk tier. This system is constantly running, constantly updating. They pull your official motor vehicle report, or MVR, from the DMV, typically at every 6-month or 1-year renewal period, to see if anything new has appeared on your record. But there's one more factor in your history that can cost you a fortune, and it has nothing to do with getting a ticket or causing a crash. It's the lapse in coverage. Let's say you sell your car and decide to go without insurance for a few months before you buy a new one. Or maybe money gets tight and you miss a payment and your policy gets canceled. In the world of insurance, this is a cardinal sin. A gap in your insurance history, even for a few weeks, is a massive red flag. Why? Because it breaks your record of continuous coverage. Insurers see this as a sign of instability and unreliability. Their data shows that drivers with lapses in coverage are statistically more likely to be involved in accidents and to be uninsured when they are. So when you go to buy a new policy after a lapse, you're immediately treated as a higher risk. You'll be hit with higher rates right out of the gate, purely because you were uninsured for a period of time. It feels deeply unfair. You weren't even driving, so how could you be a risk? But their logic is cold and calculated. Responsible people maintain continuous insurance coverage. By their definition, if you let it lapse, you acted irresponsibly, and you will pay a premium for it. Your driving history, then, is a complex tapestry woven from your mistakes, your accidents, and even your periods of inaction. It's a story that's being told about you, whether you like it or not, and insurance companies are reading every single word. They typically look back 3 to 5 years for most incidents, but major violations like a DUI can follow you for a decade or even longer in some states. The good news is, this ghost can eventually fade. Tickets fall off your record. Surcharges for accidents expire. If you can maintain a clean record for several years, you can prove you're a safe bet again, and your rates will come down. You have the power to rewrite your history one safe, uneventful drive at a time. But let's assume you've done just that. Your driving record is pristine. Not a single ticket, not a single accident, not a single day of lapse coverage. You are the perfect driver. You should be getting the best possible rate, right? Not necessarily, because even if your personal history is flawless, the history of the very car you're driving could be working against you. The specific make and model sitting in your driveway is telling insurers a story about risk, theft, and repair costs that you might not even be aware of. And that story is our next chapter. So let's pull back the curtain on that story. Imagine 2 neighbors living side by side. One drives a brand new Honda Accord. Sensible, reliable, safe. The other just brought home a Dodge Charger Hellcat, a monster of American muscle, roaring with over 700 horsepower. Both drivers have identical records, live in the same house, same age, same credit score. Yet, the Hellcat owner is paying a premium that could be 3, 4, even 5 times higher than the Accord owner. Why? It's not just because the car is more expensive. That's only the first page of the story. The first thing an insurer sees is the car's sticker price, or its MSRP, manufacturer's suggested retail price. This is the baseline. If you total a $90,000 Hellcat, the potential payout is obviously much higher than for a $30,000 Accord. This is the simple brute force math of insurance. The more the insurance company stands to lose, the more they need to collect from you to cover that potential loss. This applies to both collision coverage for when you hit something and comprehensive coverage for things like theft or a tree falling on your car. A higher value means a higher potential claim, which always means a higher premium. But if it were only about the sticker price, the story would end there. And we're just getting started. The real secret, the factor that quietly drains the wallets of so many drivers, is the cost of repair. This is where the sensible Accord starts to pull way ahead of the snarling Hellcat. Think about it. A minor fender bender in the Accord might require a new bumper cover and a headlight. There are millions of Accords on the road. The parts are mass-produced, readily available, And every body shop in the country has worked on one. The repair is straightforward and relatively inexpensive. Now let's look at that same fender bender with the Hellcat. That aggressive front fascia? It's not just plastic. It's a complex piece of performance-oriented engineering. The specialized Brembo brakes, the performance-tuned suspension components, even the unique paint color, they all cost a fortune. A single headlight assembly on a modern high-performance or luxury car, with its adaptive LEDs and complex electronics, can cost over $2,000. Just the headlight. Suddenly, a seemingly minor accident that would be a $2,000 claim on the Accord becomes a $10,000 claim on the Hellcat. Insurers don't guess at this. They have mountains of data. Organizations like the Insurance Institute for Highway Safety, or IIHS, don't just crash cars to see how safe they are. They meticulously track the cost to repair them after low-speed impacts. Insurance companies subscribe to this data. They know down to the dollar that a bumper replacement on a Subaru Outback is cheaper than on a BMW X5. They know that the carbon fiber components on a Corvette are astronomically more expensive to fix than the steel panels on a Ford F-150. Your car's repair cost profile is a massive part of its insurance story, and it's a chapter written long before you ever get behind the wheel. But the story has a positive twist too. Safety. This is where your car can actually save you money. Modern vehicles are packed with technology designed to prevent accidents or protect you when one happens. And insurance companies love it. Why? Because every accident that's avoided is a claim they don't have to pay. Think about features like automatic emergency braking. A study by the IIHS found that this single feature can reduce front-to-rear crashes by 50%. 50%. To an insurer, that's not a cool gadget. It's a statistical miracle. The same goes for blind spot monitoring, lane keeping assist, and adaptive cruise control. Each one chips away at the probability of a claim. Then there are the crash test ratings themselves. The IIHS Top Safety Pick and Top Safety Pick Plus awards are the gold standard. Cars that earn these ratings have proven they can protect their occupants in a variety of severe crashes. Better protection means a lower likelihood of expensive medical claims, which are often the costliest part of any accident. The insurer's logic is simple. If you're less likely to get hurt in your Volvo than in a 1995 compact with no airbags, they're going to reward the Volvo driver with the lower premium for personal injury protection and medical payments coverage. So, while you might buy a car for its safety ratings to protect your family, your insurance company is giving you a discount for protecting their bottom line. Now we enter a darker chapter of the story. Theft. Your car's desirability to criminals is a huge, and often shocking, factor in your insurance rate. Every year, the National Insurance Crime Bureau releases its Hot Wheels report, listing the most stolen vehicles in America. And the list might surprise you. It's not always the flashiest cars. For years, the top spots have been dominated by full-size pickup trucks like the Ford F-Series and Chevy Silverado, and dependable sedans like the Honda Accord and Honda Civic. Why? Opportunity and value for the thief. There are millions of them on the road, creating a massive illicit market for their parts. A stolen catalytic converter from a Toyota Prius can be sold for hundreds of dollars in minutes. The entire front end of a Chevy Silverado, the grille, headlights, bumper, can be stripped and sold online to repair a crashed truck. It's a criminal enterprise, and your insurance premium reflects your car's place in that ecosystem. If you own a vehicle that's high on the most wanted list, your comprehensive insurance rate will be higher, period. It doesn't matter if you live in a safe neighborhood or park in a locked garage. Statistically, your car is a magnet for theft, and the insurer prices your policy accordingly. This is also why certain models like the Dodge Charger and Challenger, especially the high horsepower variants, get hit with sky-high premiums. Not only are they expensive to repair, but they are also among the most frequently stolen cars in the entire country. They are a double whammy of risk high-speed thrill rides that are also prime targets for professional car thieves. Finally, we have to talk about what's under the hood. The raw, simple, visceral factor of performance. An insurer looks at a 4-cylinder engine in a family SUV and sees a vehicle designed for school runs and grocery trips. They look at a supercharged V8 in a 2-door coupe and see a vehicle designed for one thing: speed. And speed is the best friend of risk. It's not that they think you're going to be street racing every weekend. It's about statistical correlation. Historically, vehicles with more horsepower are involved in more frequent and more severe accidents. The physics are undeniable. A faster car can get into trouble more quickly, And when it crashes, it does so with much more energy, leading to greater damage and more severe injuries. It's a speed tax baked directly into your premium. This is why two versions of the exact same car, a base model Ford Mustang with an EcoBoost engine versus a Shelby GT500 with a supercharged V8, will have wildly different insurance costs, even if everything else is identical. More power equals more risk. It's the simplest equation in the insurance playbook. So the vehicle you choose is a complex character in your insurance story. It's not just a car. It's a bundle of statistics. It's a statement of value, a prediction of repair costs, a safety rating, a theft target, and a measure of performance potential. All these factors are calculated and cross-referenced before you even get your first quote. But even the safest, cheapest to repair, most theft-proof car in the world is only one half of the equation, because all the data about the car itself pales in comparison to the data they have on the most unpredictable component of all, the person holding the keys. You, the human element, the ghost in the machine. To an insurance company, you are the single greatest variable and the most fascinating puzzle to solve. They have spent billions of dollars and over a century creating a system, not just to understand cars but to understand the people who drive them. They've built a predictive model of you before you ever even call them for a quote. And they do it by asking some deeply personal questions, starting with the most obvious one. How old are you? This isn't just about birthdays. It's about pure, cold, hard data on risk. A 16-year-old driver behind the wheel of a brand new car is an actuary's nightmare. It's not personal, it's statistical. The part of the human brain responsible for impulse control and long-term consequence assessment, the prefrontal cortex, isn't fully developed until you're about 25. So, for that entire first decade of driving, you are, in the eyes of an insurer, a high-risk beta tester. You're learning the rules of the road at the same time you're learning the rules of life. The result? Mile for mile, teenage drivers are nearly 3 times more likely than drivers aged 20 or over to be in a fatal crash. Their rates reflect that terrifying reality. Then, as you move through your late 20s, 30s, and 40s, your rates typically begin to fall. You enter the statistical sweet spot. You've got the experience, your brain is done cooking, and you likely have more to lose: a career, a family, a mortgage. You become a more predictable, more cautious driver. The data proves it. But this discount doesn't last forever. As you enter your late 60s and 70s, you might see those rates start to creep back up. Reflexes can slow, vision and hearing might not be as sharp, and the data shows a gradual uptick in accident frequency for senior drivers. It's a statistical bookend to your driving life, with the lowest risk and the lowest rates, sandwiched right in the middle. Next, and this is where it gets controversial, they often look at your gender. For decades, the industry standard was simple. Young men pay more. A lot more. A 20-year-old male could expect to pay significantly higher premiums than a 20-year-old female with the exact same car and driving record. The justification was, once again, rooted in grim statistics. Historically, young men have been far more likely to engage in risky driving behaviors: speeding, driving under the influence, and not wearing seatbelts. They were involved in more accidents, and those accidents were often more severe. But the world is changing. Many people argued, quite persuasively, that it's unfair to penalize an entire gender for the actions of its riskiest members. As a result, a growing number of states, including heavyweights like California, Pennsylvania, and Michigan, along with Hawaii, Massachusetts, North Carolina, and Montana, have now banned insurance companies from using gender as a factor in setting car insurance rates. In these states, your price is determined by your actions, not your identity. But in the rest of the country, this practice, while debated, is still a very real component of your final price. But where you live can be an even bigger factor than who you are. I'm not talking about your state. I'm talking about your specific 5-digit zip code. You could be the safest driver in the world, but if you move one town over, your insurance premium could double overnight. Why? Because you aren't just insuring your own driving habits. You are insuring yourself against the risks of your environment. Insurers call this territory rating. They slice the country up into thousands of tiny territories, sometimes just a few square miles, and analyze each one like a separate ecosystem of risk. A dense, urban zip code in downtown Los Angeles is a completely different world from a quiet, rural zip code in upstate New York. The LA driver has to contend with crushing traffic, which means more fender benders. There's a higher rate of auto theft and vandalism. The roads might be in worse condition. There might even be a higher likelihood of weather events like wildfires. And here's a subtle one. Some areas have more lawyers per capita and a culture that's more litigious. meaning a simple accident is more likely to turn into an expensive lawsuit. Your neighbor's bad driving, the local crime rate, the frequency of hailstorms in your area. All of it gets baked into your premium. Feels unfair, like a neighborhood tax. But to the insurer, it's simple math. If they have to pay out more claims in a particular zip code, everyone who lives in that zip code is going to have to pay more to cover the costs. Your address tells them a story about the world you drive in every single day. They also want to know if you're married. This might feel like the most old-fashioned question of all, a relic from a bygone era. But it still matters. The data, collected over decades, consistently shows that married drivers file fewer claims than single drivers. The actuarial theory is that marriage is a signal of stability and responsibility. Married individuals are perceived as being more risk-averse, less likely to be out late at night, and generally leading a more settled lifestyle. It's a statistical shortcut, a proxy for maturity. Of course, getting married just to save a few $100 on your car insurance is probably not a great life plan. But the marriage discount is a real and persistent feature of the insurance landscape. But of all the personal details they dig into, the one that shocks and angers people the most has nothing to do with driving at all. It's your credit score. You might be thinking, what on earth does my credit card balance have to do with my ability to safely merge onto a highway? And it's a fair question. The answer is a concept called a credit-based insurance score. This isn't your FICO score, but it's built from the same raw material, your credit report. Insurers discovered, through analyzing massive amounts of data, a powerful and undeniable correlation. People who manage their finances responsibly also tend to manage their risk responsibly, including the risk behind the wheel. The industry's research claims that people with lower credit scores are statistically more likely to file more claims, more expensive claims, and even fraudulent claims. The logic is that your credit history is a detailed record of your conscientiousness. Do you pay your bills on time? Do you live within your means? Do you honor your commitments? The insurance company sees this as a powerful indicator of your character and your likelihood of being a responsible, low-risk client. To them, a person who is meticulous about their finances is also likely to be meticulous about maintaining their car and obeying traffic laws. This is by far one of the most controversial practices in the industry. Critics argue that it's deeply unfair, punishing people for circumstances that have nothing to do with their driving, things like job loss, medical debt, or divorce. It essentially penalizes people for being poor, not for being bad drivers. And just like with gender, some states are pushing back. California, Hawaii, and Massachusetts have banned the use of credit scores in setting auto insurance rates. But in most of the country, your financial fingerprint is one of the most significant factors in determining your premium. A poor credit score can raise your rates more than a drunk driving conviction in some states. So they've assembled this avatar of you. They've used your age to predict your maturity, your zip code to predict your environment, your marital status to predict your stability, and your credit report to predict your personal responsibility. They've built a statistical ghost of you based on who you are and where you live. But all of that is just a prediction. It's a guess. The real story, the one that can save you a fortune or cost you everything, is written not in their spreadsheets, but on the road itself. It's your driving record, and it's a story they read very, very carefully. It's the ultimate report card, the one that can't be fudged or explained away. Every other factor we've talked about, your age, your zip code, your credit score, is an educated guess about who you might be on the road. Your driving record is the unvarnished truth of who you have been. It's your driving biography, written 1 mile at a time, and insurers read it like a sacred text. This document, officially known as a Motor Vehicle Report or MVR, is the first thing an underwriter pulls when you apply for a policy. It's a detailed history of your interactions with traffic laws, and unfortunately with other vehicles. And it's divided into 2 main categories of events that can either save you a fortune or send your premiums into the stratosphere: accidents and violations. Let's start with the big one, accidents. In the world of insurance, there are 2 fundamental types: not at fault and at fault. If someone runs a red light and T-bones your car, that's a not at fault accident. You'll be relieved to know that in most states, a single documented not at fault accident won't raise your rates. But here's a nuance many people miss. A pattern of not at fault accidents can become a faint red flag. The thinking is, even if you're not causing them, you seem to be a magnet for them. Maybe you consistently drive in high-risk areas or at high-risk times. It's a subtle data point, but it can prevent you from getting the absolute best rates. But the real earthquake, the event that reshapes your entire insurance landscape, is the at-fault accident. This is the moment the theoretical risk becomes a cold, hard, expensive reality. When you are deemed responsible for an accident, you have just proven the insurance company's worst fears correct. You have cost them money, sometimes a lot of money, and they will adjust your premium to reflect this new, proven reality. How much? A single at-fault accident can increase your premium by an average of 40 to 50%. Let that sink in. If you're paying $1,500 a year, one mistake could suddenly make it $2,100 or more. This surcharge, as it's called, typically stays on your policy for 3 to 5 years. Do the math. That one fender bender where you glanced at your phone for 2 seconds could end up costing you an extra $3,000 in premiums over the next few years, on top of any deductible you had to pay. It's a brutal financial lesson in the cost of a single lapse in judgment. The more severe the accident and the higher the payout, the more devastating the impact on your rate. If accidents are the earthquakes, then traffic violations are the constant, corrosive tremors that can be just as destructive over time. Insurers see these violations as neon signs pointing to risky behavior. And just like accidents, they exist on a spectrum of severity. On one end, you have minor violations. This is the stuff most of us have been tempted by or even guilty of. A speeding ticket for going 10 miles over the limit, a rolling stop, and improper lane change. A single one of these, especially if it's your first in several years, might not even move the needle. Some companies offer first ticket forgiveness. You might be able to take a defensive driving course to have the points removed from your record. But do not be fooled. These are not harmless. They are a warning. Because when one ticket becomes 2, and 2 become 3 within a few years, a pattern emerges. The insurer no longer sees isolated mistakes. They see a habit. They see a driver who consistently disregards the rules. And that death by 1,000 cuts will absolutely cause your rates to climb slowly but surely with each new infraction. Then you have the other end of the spectrum, the major violations. These are the financial atomic bombs. We're talking about a DUI or a DWI, reckless driving, street racing, or leaving the scene of an accident. A single one of these on your record is catastrophic for your insurance. It's not a red flag. It's a 5-alarm fire. A DUI conviction can double or even triple your annual premium overnight. Many standard insurance companies will drop you outright, refusing to cover you at any price. You'll be forced into the high-risk pool, needing to file a special form called In-State Route 22, which is basically a certificate telling the state that you have the bare minimum, extremely expensive insurance required for high-risk drivers. That one terrible decision to get behind the wheel after drinking can result in tens of thousands of dollars in extra insurance costs over the decade it can haunt your record. Many states formalize this with a point system. A speeding ticket might be 2 points. Reckless driving could be 6. Your insurance company sees these points as a standardized score for your level of risk. The more points you accumulate, the more your premium will rise. Rack up too many, and the state will suspend your license, making insurance a moot point. So how long does this story follow you? The industry standard look-back period is typically 3 to 5 years. That at-fault accident from 2021? By 2025 or 2026, it might finally fade from your insurer's calculations. That speeding ticket you got 2 years ago will eventually become ancient history. But this is crucial. For the major violations, the shadow is much, much longer. A DUI can stay on your insurance record for 7, 10, or even more years, depending on the state and the insurer. It becomes a permanent chapter in your driving biography, a constant drain on your finances. But here is the most important part of this entire discussion. While a bad driving record is a liability, a clean one is an asset. It is perhaps your single most powerful money-saving tool. Every insurance company offers a good driver or safe driver discount, and it's not a token amount. It can be one of the largest discounts available, often slashing 20, 25, or even 30% off your premium. Think about 2 drivers. Let's call them Sarah and Tom. Sarah is 45, has a perfect 820 credit score, lives in a safe suburban zip code, and drives a boringly safe sedan. On paper, she is the ideal customer. But in the last 3 years, she's had 1 minor at-fault fender bender and 2 speeding tickets. Then there's Tom. He's 25, his credit is just okay, and he lives in a busier part of the city. Demographically, he's a higher risk. But for the last 5 years since he got his license, his driving record is spotless. Not a single ticket, not a single accident. Who do you think pays less? In many cases, it will be Tom. Because his real-world actions have completely overridden his demographic predictions. His clean record is proof. It tells the insurance company, forget the statistics about 25-year-olds. Look at me. I am a safe driver. Sarah, on the other hand, has proven that despite her ideal profile, her actual behavior on the road is risky. Her actions have betrayed her profile. This is the power you hold. Every single time you get in the car, you are actively writing the next sentence of your driving record. Choosing to leave a bigger following distance, deciding not to rush through that yellow light, putting your phone in the glove box. These aren't just safe driving habits. They are active financial decisions. You are literally paying yourself in the form of future discounts with every safe mile you drive. Your driving record isn't something that happens to you. It's something you create every single day. It's the story of how you drive. But there's another story being told, one that's just as critical. It's the story of what you drive. The very machine you are sitting in, its safety ratings, its repair costs, its horsepower, even its color, is broadcasting a constant stream of data to your insurer. And that story can either make you a hero or a villain in their eyes. Let's start with the hero. In the world of auto insurance, the hero car isn't a fire-breathing supercar or a rugged mountain-scaling truck. The hero is boring. It's a four-door sedan, a sensible crossover, maybe a minivan. It's the kind of car that gets a nod of quiet approval from a risk analyst, not a second glance on the street. Why? Because this car has a superpower. It's predictable. Insurance is the business of predicting the future, and this car, this hero, makes that job easy. Its story begins with two acronyms that are quietly shaping your premium: NHTSA and IIHS, the National Highway Traffic Safety Administration, and the Insurance Institute for Highway Safety. These are the organizations that smash brand new cars into barriers for a living just to see what happens. They run frontal crash tests, side impact tests, roof strength tests. They measure exactly how a dummy's head, neck, and chest react to a violent collision. A car that earns a 5-star rating from the NHTSA or a top safety pick plus from the IIHS is telling your insurer a very clear story. In a crash, the people inside me are less likely to get seriously hurt. And that is music to an insurer's ears. Because what's the single most expensive, unpredictable, and devastating part of any major car accident claim? It's not the bent metal, it's the broken bodies. Medical bills can skyrocket into the hundreds of thousands, even millions of dollars. A vehicle engineered to protect its occupants, with a strong safety cage, multiple airbags, and advanced crumple zones, is a vehicle that actively works to lower the potential medical payout. Your insurer sees a Subaru Forester or a Honda Accord with top safety ratings, and they don't see a car. They see a shield. They see a predictable, manageable risk. They see a hero. But the hero's story doesn't end with saving lives. It's also about saving money on repairs. Imagine two minor fender benders. In the first, a 10-year-old Toyota Camry gets its front bumper cracked. The cost? A few $100s for a new plastic bumper cover from 1,000 different suppliers, and an hour of labor at any local body shop. Now imagine the same fender bender, but this time it's a brand new luxury SUV. That's not just a plastic bumper anymore. It's a sophisticated piece of technology embedded with sensors for parking assist, adaptive cruise control, and pedestrian detection. The headlight isn't a simple bulb. It's an adaptive LED matrix that costs $2,000 to replace. The grille has a camera in it. Even the emblem might hide a radar unit. Suddenly, that minor fender bender isn't a few $100s. It's a $5,000 claim. Insurers have access to massive databases that track the cost of parts and labor for every single make and model. They know that fixing a Ford F-150, the most common vehicle in America, is relatively cheap because parts are everywhere. They also know that sourcing a carbon fiber side mirror for a BMW M Series or a specific electronic module for a Land Rover can be an expensive nightmare. The hero car is easy and cheap to fix. It's the Camry, the Civic, the Equinox. The villain? It's the car that turns a simple parking lot mishap into a four-figure headache. Now let's talk about the car as a target. You might think the villain here is obvious. A bright red Porsche 911 parked on a city street, just begging to be stolen. And you're not entirely wrong. High-end, desirable cars are certainly targets. But the real villains in the theft story are often the ones you least expect. They're the wolves in sheep's clothing. For years, the most stolen vehicles in America weren't exotic sports cars. They were Honda Accords and Civics, Ford and Chevy pickup trucks. Why? Because there are millions of them on the road. This creates a massive, thriving black market for their parts. Thieves don't steal a 10-year-old Accord to go on a joyride. They steal it to chop it up and sell its engine, transmission, and doors to unscrupulous repair shops. More recently, a new villain emerged. Certain models of Kias and Hyundais. A design flaw made them shockingly easy to steal, leading to a nationwide explosion in thefts. Insurance companies were hemorrhaging money paying out claims for these stolen vehicles. Their reaction was swift and brutal. Premiums for those specific models went through the roof. In some cities, insurers flat out refused to even offer new policies for them. This is a perfect example of how your car's specific vulnerability, a factor you, the owner, have no control over, can brand it as a high-risk villain in the eyes of the entire insurance industry. Your car's reputation precedes it. Of course, there is a more traditional villain, the one with pure, unadulterated horsepower. This is the most straightforward part of the equation. A 500 horsepower Dodge Charger is statistically more likely to be involved in a high-speed accident than a 150 horsepower Kia Rio. It's not a judgment on you as a driver. It's cold, hard data. More power means higher top speeds, faster acceleration, and a greater temptation to use it. The potential for a catastrophic multi-car pileup is simply higher. Insurers see a high-performance engine, and the dollar signs in their risk calculation start spinning like a tachometer needle hitting the red line. The car is broadcasting its potential for aggressive driving, and the premium will reflect that broadcast loud and clear. Now, this is where we have to clear up one of the biggest, most persistent myths in the auto insurance world: the color red. You've heard it a million times. Red cars cost more to insure. This is completely 100% false. Your insurance company does not care if your car is fire engine red, canary yellow, or boring beige. Your vehicle identification number, or VIN, which is what they use to identify your car, doesn't even contain information about its color. So why does this myth persist? It's a classic case of correlation, not causation. What kind of person is more likely to buy a bright red sports car? Perhaps someone with a slightly more aggressive or risk-tolerant personality. It's the type of car that's often painted red, the Mustangs, the Corvettes, the Ferraris, and the type of driver attracted to them that creates the higher risk, not the paint itself. The color is just a bystander that gets all the blame. Another complex area is new versus old. Common sense might suggest a brand new $50,000 car would be way more expensive to insure than a $5,000 10-year-old car. And if you're only talking about collision and comprehensive coverage, the part of your policy that pays to fix or replace your own car, you'd be right. The potential payout for the insurer is much higher on the new car. But that's only half the story. Remember the hero car's superpowers? Safety features. A new car is packed with them. Airbags everywhere, electronic stability control, automatic emergency braking. Your 10-year-old car might have none of that. So, when it comes to your liability coverage, the part that pays for injuries and damage you cause to others, the new car might actually be cheaper to insure. The insurer bets that the new car's safety tech will help you avoid an accident altogether, or at least make the accident you do have less severe, saving them a fortune in medical and legal bills. It's a fascinating paradox. The car that's more expensive to replace can sometimes be cheaper to insure for causing damage. Finally, think of your car as a resume you're submitting to an underwriter. The stock version from the factory is one thing, but what about the modifications you've made? That custom exhaust, the engine tune that adds 50 horsepower, the giant spoiler on the back? To you, these are upgrades. To an insurer, these are red flags. You are actively changing the car from its tested, predictable factory settings. You're increasing its performance, making it a bigger theft target, and signaling that you are a driving enthusiast. A term that, to an underwriter, is often synonymous with risk-taker. Failing to disclose these modifications can even be grounds for denying a claim. You're rewriting your car's story, and in the process, you might be turning your dependable hero into an unpredictable and very expensive villain. The machine you drive is a massive character in your insurance story. Its safety record, its repair costs, its popularity with thieves, and its performance potential all combine to create a risk profile that is incredibly detailed. But it's still just one character. Because even the safest, most reliable, most boring car in America can carry a shockingly high premium if it's driven by the wrong person. And the story of that person, you, is what we need to decode next. When an insurance company looks at you, they don't see a person. They see a collection of data points, a risk profile. They become actuary statisticians and, in a way, fortune tellers trying to predict the future. Your future. specifically the likelihood that you will cost them money. To do this, they build a story about you piece by piece, using factors that might seem completely unrelated to how you handle a four-way stop. Let's start with the most obvious and unavoidable chapter in your story: your age. This is the bedrock of insurance pricing. A 16-year-old getting their license for the first time is, in the eyes of an insurer, the single riskiest asset they could possibly cover. It has nothing to do with judging their character. It's about cold, hard numbers. The CDC reports that the crash rate per mile driven for 16 to 19-year-olds is almost 3 times the rate for drivers aged 20 and over. It's a brutal statistic, driven by a cocktail of inexperience and biology. The part of the brain responsible for rational decision-making and impulse control, the prefrontal cortex, isn't fully developed until you're about 25. Insurers know this. So for the first decade of your driving life, you're paying a brain is still under construction tax. Your rates will typically start to fall every year you drive without an accident, with a significant drop around age 25. From there, you enter the golden era of insurance rates, roughly from your late 20s to your late 50s. This is when insurers see you as the ideal client: experienced, mature, and statistically at your peak as a safe driver. But then, something interesting happens. As you approach your late 60s and 70s, the rates can start to creep back up. It's a gentler curve than the one you faced as a teen, but it's there. Vision can decline, reaction times can slow, and the data shows a slight uptick in accident frequency for elderly drivers. It's the bookend to your driving story. Risk is high at the beginning and slowly rises again at the end. Next, we have a factor that's become increasingly controversial: your gender. For decades, the math was simple and unwavering. Young men, particularly under the age of 25, paid significantly more for insurance than young women. The data was overwhelming. Men were statistically more likely to speed, more likely to get a DUI, less likely to wear a seatbelt, and tragically involved in far more fatal accidents. To an insurer, a 19-year-old male was a different species of risk than a 19-year-old female. But the world is changing. The public and regulators have started to question whether it's fair to penalize an entire demographic for the actions of a few. As a result, several states, including California, Hawaii, Massachusetts, Michigan, North Carolina, and Pennsylvania, have banned the use of gender in setting auto insurance rates. In those states, your gender is irrelevant. But in the rest of the country, the old actuarial tables often still apply, and a young man can expect to see a higher bill, purely based on statistics. Now we move from biology into lifestyle, and this is where it gets weird. What does saying "I do" have to do with your chances of running a red light? To an insurance company, a lot. Married drivers consistently pay less for car insurance than their single, divorced, or widowed counterparts. The discount can be substantial, sometimes as much as 10 to 15%. The logic here is purely correlational. Insurers aren't making a moral judgment. They've just crunched a century's worth of data and found that married individuals, as a group, file fewer claims. The prevailing theory is that marriage is a proxy for stability and responsibility. The act of settling down, perhaps starting a family or buying a home, tends to correlate with a more cautious approach to life, including driving. So that wedding ring on your finger tells an underwriter that you are statistically less likely to be street racing on a Saturday night. Speaking of buying a home, that's another chapter in your personal story that insurers are very interested in. Homeowners almost always get a better rate than renters, even if you don't bundle your home and auto policies together. Just like marital status, homeownership is seen as a sign of financial stability and responsibility. It suggests you have roots in a community, that you have more to lose, and are therefore a lower risk. It's another brushstroke in the portrait they're painting of you as either a predictable, stable client or a volatile, high-risk one. But of all the personal factors, of all the pieces of your life they scrutinize, one stands above the rest in its power to dictate your premium. It has nothing to do with your driving, yet it can affect your rate more than a speeding ticket. It's your credit score. This is, without a doubt, the most misunderstood and controversial factor in the entire insurance industry. And let's be crystal clear about one thing. Insurers aren't checking your credit to see if you can afford to pay your bill on time. They have other ways to deal with that. They are using your credit history to predict how likely you are to file a claim. More than 20 years ago, the insurance industry started running massive data analyses. They were looking for hidden correlations, any variable that could predict future losses. And they found a statistical goldmine. They discovered a shocking, almost unbelievable correlation between a person's credit history and their likelihood of filing an insurance claim. People with lower credit scores as a group not only filed more claims, but they also filed larger, more expensive claims. The correlation was so strong, so undeniable, that they developed a specialized product called an insurance score, based on your credit report. It looks at things like your payment history, your level of debt, the length of your credit history, and any bankruptcies or collections. They found that how you manage your finances is one of the single best predictors of how you manage risk in all other areas of your life, including behind the wheel. The theory is that a person who is diligent about paying bills on time, who manages debt responsibly, and who lives within their means, is also more likely to be the kind of person who gets their oil changed on time, replaces their tires when they're worn, and doesn't take unnecessary risks on the road. Conversely, someone with a chaotic financial life might be more prone to making impulsive decisions in general, which can translate to the driver's seat. It's so powerful that a driver with a poor credit score and a perfect driving record can, and often will, pay a higher premium than a driver with an excellent credit score and a DUI on their record. Let that sink in. This practice is legal in all but a handful of states that have banned or limited its use. Insurers defend it vigorously, arguing it's one of the most statistically accurate predictors of risk they have. Without it, they say, all the responsible low-risk drivers with good credit would have to pay more to subsidize the high-risk drivers with poor credit. To consumers, it can feel deeply unfair. A penalty for having student loans, medical debt, or losing a job. It feels like you're being judged for your financial life, not your driving life. But in the cold calculus of insurance, the two are inextricably linked. So the insurer has now built this incredibly detailed picture of you. They've used your age and gender to assess your biological risk profile. They've looked at your marital status and homeownership to gauge your stability. And they've analyzed your financial history to predict your fundamental attitude toward risk. This is the character they have created, the protagonist of the story. But this is all just a prediction. It's a guess about who you might be behind the wheel. The final and most powerful piece of the puzzle is your past. Your history. Your driving record. And the story that record tells can either save you a fortune or cost you one. Your driving record isn't just a list of dates and incidents stored in a dusty file at the DMV. It's a living document. It's the narrative of you, the driver. Every other factor we've discussed, your age, your car, your zip code, even your credit score, is an educated guess. It's an actuary in a back room looking at a spreadsheet and saying, based on millions of other people like you, we predict you will behave this way. But your driving record? That's not a prediction. That's proof. It's the ground truth of your habits, your judgment, and your risk, written not in ink but in action. And in the world of auto insurance, this story is the ultimate authority on how much you will pay. Let's break down the three main chapters of this story that insurers read most closely. The first and most damaging is the at-fault accident. This is the big one. When you cause an accident, you are confirming the insurance company's single greatest fear: that you are a person who costs them money. Think about it from their perspective. They are in the business of collecting premiums and, ideally, not paying out large claims. An at-fault accident is a direct hit to their bottom line. But it's more than just the cost of that one claim. It's a powerful data point that screams, higher future risk. You have demonstrated, in the real world, an inability to avoid a costly incident. The term at fault is critical here. If someone runs a red light and plows into you while you're sitting at a green, that's a not at fault accident. While it might still be a headache, and in some rare cases can slightly impact your rates depending on state laws and no-fault systems, it generally doesn't carry the same catastrophic weight. But if you're the one who rear-ended someone because you were looking at your phone, or you misjudged a turn and sideswiped a parked car, you are deemed at fault. Police reports, witness statements, and insurance adjusters will piece together this conclusion, and once it's on your record, it's a bright red flag. Most companies will apply a significant surcharge to your premium after an at-fault accident, an increase that can easily be 30, 40, or even 50%. And this isn't a short-term penalty. This dark chapter stays in your story for a while, typically haunting your rates for 3 to 5 years. One mistake, one moment of distraction, can literally cost you thousands of dollars in increased premiums over the next half-decade. The second critical chapter is your history of moving violations. These are the tickets you get for breaking traffic laws while the car is in motion. We're not talking about parking tickets. Insurers generally don't care about those. We're talking about speeding, running a stop sign, making an illegal U-turn, or tailgating. Insurers see these violations as leading indicators. They are the warning signs, the foreshadowing that a bigger, more costly event, an accident, might be on the horizon. A driver who consistently speeds is, statistically, more likely to be involved in a high-impact collision than one who obeys the limit. A driver who runs red lights is playing a dangerous game of chance. These violations are not all created equal. They exist on a spectrum of severity. On the minor end, you have a ticket for going 10 miles per hour over the speed limit. It's not good, and it will raise your rates, but it's manageable. On the major catastrophic end, you have violations like a DUI or DWI, reckless driving, or leaving the scene of an accident. These are the ultimate deal breakers for an insurance company. A DUI isn't just a mistake. It signals a profound and terrifying lack of judgment. It tells an insurer that you are willing to take the ultimate risk, not just with your own life, but with the lives of others and with their financial assets. Getting a major violation like a DUI can cause your insurance premium to double, triple, or even more. Some standard insurance companies may even drop you altogether, forcing you to seek high-risk insurance, which is incredibly expensive. You'll also likely need to file in State Route 22, a certificate your insurer files with the state to prove you have coverage. It's basically a label that marks you as a high-risk driver for years to come. While a minor speeding ticket is a negative mark in your story, a DUI is like a plot twist that changes the entire genre from a drama to a horror film in the eyes of an insurer. The third and often overlooked chapter of your driving story is your insurance history itself. Specifically, any lapses in coverage. This is a subtle but powerful signal of risk. If you sell your car and don't plan to drive for a year, that's one thing. But if you own a car and simply let your policy expire for a month because you forgot to pay or were trying to save money, insurers view that very negatively. Why? For two primary reasons. First, it suggests you may have been driving uninsured, which is illegal and exposes the entire system to greater risk. Second, it can be seen as an indicator of financial instability, which, as we know from the credit score discussion, is statistically correlated with a higher likelihood of filing claims. Maintaining continuous insurance coverage, even if you switch companies, is one of the most important things you can do. A long, unbroken history of being insured tells a company that you are responsible and reliable. When you apply for a new policy, one of the first things they check is whether you currently have coverage. Coming to them with an active policy from another company results in a much better rate than coming to them with no coverage at all. A lapse of even a few weeks can erase any continuous coverage discount and flag you as a riskier client, raising your initial quote significantly. So you have these three chapters: accidents, violations, and lapses. Together, they form the narrative of your past. But here's the most important part of this story. It can be rewritten. Your driving record is not a permanent stain. Insurers have what's called a look-back period. For most standard incidents like a minor ticket or a single at-fault accident, they typically only look back 3 to 5 years. This means that the speeding ticket you got 4 years ago may have no impact on the premium you're quoted today. That fender bender from 2018? By 2023, it might as well have never happened in the eyes of the pricing algorithm. This creates a path to redemption. If you have a few blemishes on your record, your number one mission is to drive clean. Every single day you drive safely is a step towards a cheaper future. Every year that passes without an incident is like a chapter of your old, costly story fading away, replaced by a new narrative of responsibility. For more severe violations like a DUI, the look-back period is longer, often 7 to 10 years, but even that eventually fades. The difference this story makes is staggering. Imagine two identical 30-year-old drivers. Let's call them Sarah and Tom. They live in the same apartment building, drive the same model car, and have the same credit score. But Sarah has a clean record. No accidents, no tickets. Tom has one at-fault accident from 2 years ago. Sarah gets a quote for $110 per month. Tom, identical in every other way, is quoted $185 per month. That's a $75 difference every single month. Over the 3 years that accident will likely affect his rates, Tom will pay an extra $2,700 for that single mistake. That's the power of the story your record tells. It's the difference between an affordable necessity and a burdensome expense. Your driving record is the story of your past. It's the most powerful factor because it's a record of your actual behavior. But even if your story has a few blemishes, it doesn't have to be a life sentence for high premiums. The final piece of this puzzle is learning how to play the game. It's about actively seeking out the opportunities and strategies that can slash your bill, regardless of what your record says. It's about finding the hidden discounts and knowing the right questions to ask, turning you from a passive price taker into an active, empowered consumer. So let's start with the single most powerful tool in your arsenal, the comparison quote. Loyalty to an insurance company is almost never rewarded. In fact, it's often punished with something called price optimization, a fancy term for gradually increasing your rate over time, betting you won't notice or won't go through the hassle of switching. They count on your inertia. Your power comes from breaking that inertia. You should be shopping for car insurance at least once a year, and always after any major life event. Moving, getting married, buying a new car, or even just celebrating a birthday that puts you in a new age bracket. Think of it like this. You wouldn't buy the first car you see on the lot without checking prices elsewhere. Why treat your insurance any differently? The process is easier than ever. You can use online aggregators to get a quick snapshot, but don't stop there. Go directly to the websites of major carriers. And here's a pro tip. Call an independent insurance agent. These agents work with multiple companies and can often find deals and policy combinations you'd never uncover on your own. Their goal is to find you the best fit, not just sell you one brand. Now let's talk discounts. This is where the real money is saved. Most people know about the obvious ones. Bundling your auto and home insurance, getting good grades if you're a student, or having a clean driving record. That's beginner level stuff. We're going for the master class. Did you know that your job or your alma mater could save you hundreds? These are called affinity discounts. Insurance companies partner with large corporations, professional organizations, alumni associations, even credit unions. If you're a teacher, an engineer, a nurse, or a member of the military, there are likely specific discounts waiting for you. You just have to ask. Go to your alumni association's website. Check your employer's benefits portal. The discount is often hidden in plain sight, a reward for a group they've identified as being lower risk. Then there are the payment-related discounts. These are simple but effective. Agree to go paperless. Set up automatic payments from your bank account. And the big one, pay your premium in full. If you can afford to pay for the 6-month or 1-year policy upfront instead of monthly, you can often knock 5 to 10% right off the top. Why? Because it saves them administrative costs and ensures they get their money. Let's look at your vehicle. Beyond just being a safe car, does it have specific features? Anti-theft systems, whether it's a passive alarm or an active tracking device like LoJack, can earn you a discount. Daytime running lights? That's a discount. Anti-lock brakes? That's another one. These might seem small, but they stack up. When you get a quote, you need to be a detective for your own car, listing every single safety and anti-theft feature it has. And what about your driving habits? If you've transitioned to working from home or have a short commute, you need to demand a low mileage discount. Insurers base their rates on risk, and the less you're on the road, the lower the risk. Don't pay for miles you aren't driving. And consider taking a defensive driving course. Even if you have a spotless record, completing an approved course can shave points off your license if you do get a ticket, and more importantly, it can give you a persistent discount on your insurance for years. The small cost of the course can pay for itself many times over. This brings us to the most modern, and perhaps most controversial way to save: telematics or usage-based insurance. This is where the insurer gives you a small device to plug into your car, or has you use a smartphone app that tracks your actual driving behavior. It monitors things like how hard you brake, how quickly you accelerate, the time of day you drive, and how many miles you cover. Now, this isn't for everyone. There are legitimate privacy concerns. You are handing over a massive amount of data about your movements and habits. And if you're a driver who tends to brake hard or frequently drives late at night, it could actually work against you. But if you are genuinely a safe, conscious, low-mileage driver, this can be a game changer. The discounts can be substantial, sometimes as high as 30 or 40%, because the insurance company is no longer guessing about your risk level. They have the data. You are proving to them in real time that you are a good bet. It's the ultimate way to have your rate based on your actions, not your demographics. Beyond just finding discounts, you need to think strategically about your coverage itself. The quickest way to lower your premium is to raise your deductible, the amount you pay out of pocket before insurance kicks in. If you raise your collision deductible from $250 to $1,000, your premium will drop significantly. The crucial caveat here is that you must be able to comfortably afford that higher deductible. Keep that amount $1000 in this case in a savings account. Think of it as self-insuring for the small stuff. You're telling the insurance company you'll handle the minor fender benders, and you only need them for the major catastrophes. And as your car gets older, the math on your coverage changes. If you're driving a 10-year-old car that's worth maybe $2,000 or $3,000, does it still make sense to pay for collision and comprehensive coverage? A good rule of thumb: if the annual cost of your collision and comprehensive coverage is more than 10% of your car's cash value, it might be time to drop it. You could end up paying more in premiums over a year or two than the car is even worth. Finally, never underestimate the power of a simple phone call. Online quote tools are great, but they are not exhaustive. Get your best online quote, and then call that company's competitor. Talk to a human being. Tell them the quote you have and ask point blank, "Can you beat this?" This is where you ask about every single discount we've discussed. Run down the list. Do you have an affinity discount for my university? A discount for my profession? What about my anti-theft device? An agent on the phone can often find and apply discounts that the automated online system might miss. So what have we learned through all of this? We've learned that your auto insurance cost is not some mysterious, fixed number handed down from on high. It's a complex calculation and algorithm with dozens of inputs. And while you can't change your age or what happened on the road 3 years ago, you have far more control than you think. You have control over the car you choose to drive. You have some control over your location, and significant control over how your credit and driving history evolve over time. But most importantly, you have total control over how you shop for it. You have the power to ask the right questions, to demand every discount you're entitled to, and to tailor your coverage to your actual needs. Your insurance premium is a reflection of risk. Your job is to present yourself honestly and accurately as the lowest possible risk. You do that by being a safe driver, a responsible bill payer, and a smart, proactive consumer who isn't afraid to walk away and take your business elsewhere. The world of auto insurance is designed to profit from confusion and complacency. But now you have the playbook. You understand the factors, you know the strategies, and you hold the power to turn one of life's most frustrating expenses into a testament to your own financial savvy.